continuing on with our topic of non-current assets, remember this is a big topic, it always gets examined. One of the final bits that we're going to have a look at with tangible non-current assets is accounting for revaluations. Now, when we talk about revaluations, this is subsequent accounting treatment. So after you've initially recognised the asset at cost, during the asset's life, you may choose to adopt a policy of revaluing that asset. Okay, so this is at some point during the asset's life that this happens. Now, when a non-current asset is originally purchased, usually the cost is what we used at the initial recognition, which we saw in earlier chapters. Now, when we think about that original cost, that cost is going to be sat in our accounts for several years. Remember, that cost account doesn't really change, does it? Now, if you purchase, let's say, a building, so let's say a factory, 7 years ago, and you purchased it for, I don't know, $3,000, so you got it at a bargain price, chances are that actually, rather than it depreciating in value, the market price, if you were to sell it today, would obviously be quite a bit different. A lot of the time, that would be higher than the original cost. So maybe you could sell that factory for $30,000 today, if you were to sell it on the market. Now, obviously, you're not going to sell that property, because if you did, then obviously it would be a disposal that we saw in the previous session. But we're leaving it in at its original depreciated historic cost at $3,000 less depreciation, yet in real life, if you were to sell it today, you could sell it for $30,000. Its market value is substantially or materially different to the original cost less its accumulated depreciation. Now, because of that, IAS 16, the standard on tangible non-current assets, says, well, if we want to give a more relevant and up-to-date view of the accounts for our users, so shareholders, etc., surely it would be better to give a better, more accurate current value of that non-current asset, so the market price, rather than its original depreciated historic cost. IAS 16 says, well, it's up to you whether you want to incorporate that valuation. You can either leave it in at its depreciated historic cost, like we've seen in the earlier recordings, or you can choose to revalue all of your buildings to their current fair value, which usually is indicative of their market value. Think about it. If you leave your assets in at their depreciated historic cost, it's going to give you more reliable information. Reliable because you can verify the invoice price or the purchase price of the cost of that asset. Whereas if you revalue your assets and take them up to their revalued amount, their market value, then it's going to give more relevant information. It's more up to date, it's more current. Now, the IAS 16 standard gives you that choice. Do you go for more relevant or more reliable? Okay. This is where we have a bit of a toss-up, I suppose, between those two characteristics. But it's up to you to decide on what policy you want to choose. So as the management of a business, do you leave it in at its historic cost or do you revalue? Well, if you do choose to revalue, great. The standard allows it. You can increase your asset values up to their current value, their fair value. However, there has to be some rules that are to be complied with if you're going to choose that policy of revaluation. So, moving on then, this choice of policy. If you choose to revalue your asset, well, if you choose to revalue your asset, you have to revalue all of your assets within the same class. Okay? So all of the same category of assets must be revalued. So you can't just say, building A has increased in value by $27,000, I'll revalue that. but actually building B has actually gone down in value, so I'm not going to revalue that. No. If you revalue one building, you revalue all of your buildings. It's to avoid this idea of cherry picking. You know, picking the ones that you like that will give you more favourable results in your financial statements, and ignoring all the items that maybe won't give you a such favourable position in your financial statements. So, if you revalue one type of asset in a category, you have to revalue them all. So all of your buildings, not just the ones that you want to revalue to make everything look good. Okay, so it's to avoid that cherry picking. Revaluations must be regular. Now, the standard doesn't say how often that is. It really depends. Okay, it depends on the business. It depends on where you're getting those values from as an estimate of the fair value of that asset. It depends on the market. With the property market in the UK, for example, the property prices have been declining quite a lot recently. So maybe the management of a company would look at the fair value of its assets more often now because of the way the market is than maybe 2 or 3 years ago. Okay, so although it doesn't say how often, we'd say, I don't know, every couple of years, even once a year at the year end, just to make sure. Any subsequent depreciation on that asset will be based on the revalued amounts. So taking my first example, if you've got a building which you've been depreciating based on its cost of $3,000 and you're going to revalue it up to its current market value of $30,000, well, you still have to depreciate that asset as per IAS 16, but you're going to depreciate that asset based on the new valuation, the $30,000, and not its old historic cost. And finally then, the other thing we need to think about is that gains from revaluing an asset, now think about it, of course it's a gain. If you're increasing your assets, that's going to benefit the owners of the business, isn't it? It's a good thing. Anyway, gains from revaluations are not taken to the statement of comprehensive income. So this gain is not a profit, okay? You will only gain real profit or real income once you dispose of that asset. Okay, so remember we talked about disposals before. What we treat it as is a recognised gain. We're recognising the fact that our assets have increased in value and that's going to benefit the owners of the business. But it is not taken to the statement of comprehensive income. It actually forms part of the owner's capital or equity of the business. Because no gain actually exists. That gain will not materialise, will not be realised until such time that you dispose of that asset. But you have to recognise that a gain has occurred. So let's see how we calculate this gain, or indeed loss, when you revalue your assets. So you can see that little diagram there. Again, this is to help you calculate the gain or loss on revaluation. So you are going to need to learn that. So starting off then, we've got the valuation. That's going to be the revalued amount of the asset. So from my example, that would be the $30,000, what I want it to be, the valuation. I'm then going to compare that with the carrying value of the asset at the date of revaluation. So always be mindful of the date given to you on the date that you want to revalue the asset, or the management want to revalue the asset. Carrying value, cost minus accumulated depreciation. So assuming that that asset that originally cost us $3,000 had accumulated depreciation of, let's say, $1,000, then the carrying value would be $2,000. All right. Now, the difference then will give you a revaluation gain or indeed loss or an impairment. That gain is what we're interested in, that positive figure that drops down the bottom. You've got a gain on the carrying value of that asset because its fair value or market value is a lot higher than its carrying value. Now, you've calculated the gain. You know how much gain is going to be recognised. Now what we need to do is record it in our journal. So here we go then, a journal adjustment for a revaluation upwards, so a revaluation gain. Think about what we're doing. We're going to increase the value of the asset up. So we are going to debit the asset cost account in the statement of financial position to increase that asset value upwards. Now, if you've got an asset that cost 3,000 and you want it to be 30,000, well, then what you need to do is debit it with the difference between what you've already got sat there and what you want it to be. So 27. What you then need to do at that point is to remove and decrease the accumulated depreciation account. Now, the accumulated depreciation account needs to be cleared down. So then when you take the cost, the new cost, minus the accumulated depreciation, which would be nil, then the cost would be the new valuation that you want to incorporate into your financial statements. Okay? So then what we would say is debit asset cost with the 27,000, the difference between the original cost of 3,000 and what we want it to be of 30,000. Debit accumulated depreciation to clear it out, so that would be the other 1,000. And then your corresponding credit entry would go to the revaluation reserve. Now this is a new account. This is a capital or equity account. Okay, so we're going to increase owner's equity or capital with the revaluation reserve. It benefits the owners of the business. Okay, so you remember we talked about capital plus profit? Well, it'd be capital plus profit plus revaluation reserve. It benefits the owners, but it is not real income yet. It will only be real income once we've disposed of that asset. Now, if you're comparing the valuation of 30 to its carrying value of 2, then obviously the credit to the revaluation reserve would be 28, and the double entry would indeed work. So, we must learn this new account of the revaluation reserve. It is a recognised gain. It benefits the owners of the business, but is not a realised gain. It's not an actual income item. It's not going to increase profits until such time as you dispose of the asset. So until that time comes, we've got to make the double entry work. It's going to the revaluation reserve as a recognised gain. So I think we'll leave it there in terms of accounting for revaluations. This is the theory behind it. In our next video, we'll have a look at putting some life into it by putting some numbers to it in an example. Thank you.